step in. So yeah, it's something people should really, really pay close attention to. And if the banks don't want to lend money to other banks, what does it say about keeping your money within a banking system? What does it say about the systemic risks within the banking system itself? I think people should think about that as well. This is one of the things that we've talked about a lot on your show, is just how safe is the banking system with the change to Universal Commercial Code, with the great taking by David Rogers Webb, with being an unsecured general creditor over the FDIC limit. All of these things we've talked about, bail-ins versus bailouts, for a long time, this is how it would start. In essence, this is where the trouble starts before the stocks get wind of it, before the credit markets get wind of it, before the media gets wind of it. It starts right here because you're talking the most well-informed traders on the planet.
In today's news recap, gold, silver, platinum price forecasts, gold rebounds despite stronger dollar. Gold received support near the $4,000 level and rebounded above the $4,500 level. Despite stronger dollar, if gold stays above $4,050, it will move towards the resistance, which is located in the $4,170 to $4,180 range. Silver climbed back above the $50.50 level as gold to silver ratio pulled back towards the $80 level. A move above the $51 level will open the way to the test of the resistance at $52.60 to $52.80. Platinum made an attempt to settle below the $1,520 level, but lost momentum and rebounded towards $1,540. In case platinum climbs above the 50 moving average at $1,550, it will head towards the resistance at $1,620 to $1,630. Some of the froth has been blown off in a much-needed correction, Rona O'Connell, an analyst at StoneX, said in a note. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
It goes into delivery at that point. I think it's the 28th of November. This is where you could say instead of the rubber meets the road, it's where paper meets physical. Those who want to stand for delivery can on the 28th. They don't have to do it on the 28th, but this is when typically they'll declare, yes, we're going to stand for delivery. And when you look at gold right now, it's business as usual. You have spot right now. I looked this morning. It was like $1.60, I think, over the December futures contract. And that is classic Contango, right? And so you have the futures price is going to be, and it's actually under the December futures contract, spot is about $1.60 under the December futures contract, which is classic Contango, which means the further out you go, you're supposed to pay a higher price. And that takes into account things like storage, interest expense, the cost of money. So in other words, if the spot was 4,100 an ounce, it would be 4101.50. Something like that for the December futures contract. As we get much closer to the end of the contract, when you can stand for delivery, it should get narrow and narrow and narrow and get closer to 1-to-1. The further out you go, the larger that contango, the larger that interest expense, the larger the cost of storage. That's normally how it works. So if you go a year out, it may be $25 an ounce more because of the cost of money, the cost of interest, and the people who are betting on it says, yeah, it's going to be $25 higher in a year. That's contango. Backwardation is something you don't see in the metals market very often. It's where the spot price is over the futures price, not under like gold and contango in normal market, but over. And that's backwardation. And it's rare, especially this close to expiration. What it basically says is someone wants physical silver now, not later, and that they see tightness in inventories and immediate demand is outpacing the expected supply. In other words, I don't care what the futures say. I will pay more for it today. I don't want to give you, kind of like what the banks are saying. I don't want to wait one day. I don't want to wait any time at all. I want it right now. And this kind of spread, especially as we get close to expiration, doesn't happen unless something's off. And it usually comes right before a big move in the metals market. So I think it's interesting to see, this is what we've been talking about for a long time. Now, for a minute, we saw the market when 50 plus million ounces found their way to London. We saw the market shift from big backwardation as much as $3 an ounce to Contango, as it's supposed to be, lasted not more than a day or two, if that. And now all of a sudden we're back in backwardation again. And that just simply says a lack of trust. And this is a theme we see everywhere, whether it be the leaving or the dumping of treasuries by countries like Japan, who has its own problem right now with the $110 billion stimulus package that they're throwing out because the yen is collapsing to a 35-year low. But you're seeing it with, the world doesn't trust our treasury market anymore because of fiscal irresponsibility and sanctions like we did to Russia. And Trump saying a 500% tariff if you support Russian energy purchases. Well, that's not a tariff, that's a sanction. They don't trust us. The banks don't trust each other. And now the exchanges, the players within the biggest exchanges on the planet don't trust each other to the point where they say, nah, I'm going to pay more for it right now than I will for it in the future. That is backwardation. That, again, the theme is no one trusts each other. And that's a problem in a world where everything is based upon trust. And if the trust is eroded, if your wife cheats on you, how long does it take for you, if ever, to get that trust back? Now, that's a bad analogy, but the point is the same. We are a country, we're the good guys. We were based on, a moral high ground and doing the right thing. And you could argue whether it be the constant political bickering, whether it be, the way the world looks at us being in Iraq, yet passing judgment for 22 years, mind you. We're still there. We never found the weapons, but the way we passed judgment on Russia. Now, I'm not making making a statement on either, but I'm just saying the world looks at us as being hypocritical. And the treasury market based on trust with massive fiscal irresponsibility and countries wondering if they're going to be the next one to be sanctioned, everything seems to be...
In today's news recap, gold deposit accounts in banks nearly double in third quarter. Gold prices hitting record highs have triggered a sharp increase in demand worldwide and in Turkey, according to World Gold Council data, which reported that global gold demand reached an all-time high in the third quarter of this year. Data from the Banking Regulation and Supervision Agency indicated that gold deposit accounts in the Turkish banking sector doubled during the same period. Gold deposit accounts in Turkish banks surged by 99.1% in the third quarter of 2025 compared to the same period last year, reaching 2.72 trillion Turkish liras. The robust growth was driven by increased investment demand, which reached 537 tons in the third quarter, supported by geopolitical uncertainties and dollar weakness. In the first 9 months of the year, global gold demand was 1% higher, reaching 3,717 tons, equating to $384 billion in value and rising 41% on an annual basis. It noted that the central banks increased their gold purchases in the third quarter, totaling 220 tons of net gold, representing a 28% increase compared to the second quarter and a 10% increase compared to the same period last year. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Something is happening in my mind beneath the surface of the financial system because over a 5-day stretch over the last 2 weeks, the Federal Reserve injected $125 billion into the repo market. And the popular talking heads would say it was to ease funding stress, as we saw in 2019 with the repo market problems, in 2008 with the fail of Lehman Brothers and the great financial crisis. But it's important to understand that 125 billion, especially over a few days, over a period of 5 days, is akin to crisis-like behavior. It's on par with what we saw when Lehman fell. It's on par to the 2019 blowout in the repo market. But let's first kind of try and dumb down what the repo market is. It's the plumbing of the financial system. And it's where banks, big banks, lend to each other overnight, literally overnight. And they do this to keep things flowing, if you will. Normally, this market, you never hear about it, and that's what it's supposed to be. It's quiet. It means everything's working. But when the Fed steps in with huge amounts of cash, mind you, typically, if there's no stress, you won't see much of any movement in the repo market or usage of it. If there's a little bit of stress, you might see 3, 4, 5 billion put into it or trading in it. If there's moderate stress, maybe 10, 12 billion. At 125 billion, it's the equivalent of hearing loud banging noise every time you turn your water on in the walls. Something's not right. Something's not flowing right. But what makes this concerning and very different than what we saw in 2008 and 2019 is that in 2008 and 2019, it was an issue of liquidity or lack thereof. Now, this is not a we're out of money problem. Today, the big banks that would trade in the repo market actually have twice the reserves that they had during the 2019 repo crisis. And in this environment, the Fed would rarely, if ever, inject liquidity into the overnight market when reserves are this high. In this environment, repo injection should be near zero because the banks have enough money to trade with one another back and forth. It's just overnight exchanging collateral, typically treasuries, sometimes mortgage-backed securities or whatnot. But this isn't about money. It's about trust or lack thereof. And in essence, then again, banks are looking at each other and saying, not a chance in the world am I going to borrow anything or lend anything to you, or not even for one night. And because I'm not sure you're going to pay me back tomorrow morning. And the reason this matters is because you typically only see repo market stress right before market corrections. And that's an ominous sign. It's an ominous sign in that this is all about the lack of trust. And when the most well-informed traders on the planet, the very, very large commercial banks, are saying, you know what, I'm not lending my money into this system. I'll just park it at the Fed instead. I am not going to do it. And you start to see the overnight lending system dry up. It portrays, I think, serious fractures within the entire system and is far more concerning than just a lack of liquidity. It's a lack of trust, which is far more systemic and troubling. So, I mean, the banks are trading with other banks, smaller, regional maybe, and also with large hedge funds. And even though you would think that this would be something that should be easy peasy, it's not. And because now it's a lack of trust, it's also a lack of faith in collateral. We've been seeing a lot of subprime and mortgage-backed securities, not subprime, but mortgage-backed securities rather, used as collateral. Now you would do that after you've already, you're doing that because you don't have treasuries or you don't want to trade your treasuries. You're trying to give the collateral that is less than perfect, so they don't trust the collateral and or they don't trust the partners. That is not a good thing because you're trading overnight. You're talking the most liquid, safe, secure trading platform on the planet. You can't get more conservative than trading overnight with the big banks and using a collateral that is either mortgage-backed securities, which are bundled, or the treasuries. And this portrays that the system itself is rotting from underneath. And the big players know this. It's concerning for sure. And I think people should keep a close eye on it.
What do you think of today's show? Is a long consolidation already happening, or is this just a healthy pullback in a mega rally that still has legs to surprise everyone and their mother? Post in the comment section down below your action plan for November and share with the stackers your price prediction for the end of the year. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.